you to the Financial Services Council and Workplace Savings New Zealand for including a session on responsible investing. Just very briefly, I've been involved in responsible investing probably for about a decade now, and one of the things that a collective of us did back in 2010 was kick off a responsible investment conference that was held in conjunction with a number of organisers, including the Responsible Investment Association of Australasia, New Zealand Super, and one or two product suppliers, including AMP Capital. And it was a relatively small affair. It was about a half-day event. There were certainly well under 100 people in the room back then. And what we've seen, I think it's tantamount to the increase in interest and growth in responsible investing, is that conference as a representation has grown significantly over the last 8 years or so. This is not a plug per se, but we have our next conference coming up in about 2 weeks' time in Auckland, and we would expect at least 160, something like 12 sponsors, and a very vibrant and broad church of people and groups coming along to that type of conference. So I would say really all I want to do in terms of kicking off and how we're going to run the session today, I'm just going to say a few words by way of introduction in terms of responsible investing, and then we've got a number of questions I'm going to ask of our expert panel here that will hopefully draw out some topical themes and areas of interest in terms of responsible investing. The first thing I'd say is I think responsible investing is really big business. It's a big mainstream form of investing. RIA run a benchmark report that was published very recently. According to RIA's report, there are now 183 billion of assets invested by New Zealanders across a whole range of institutions in what would be broadly defined as responsible investment funds. And that is up significantly. If you go back to 2010, which was the first year we ran the conference, that was about 17 billion. You've seen a massive increase, particularly over the last 3 years, following on from the, I guess you'll recall to some degree the outcry when a lot of KiwiSaver providers were caught holding investments in things such as cluster munitions, tobacco, etc. So responsible investing is big, it's growing, and I would say that it is very much a mainstream form of investing in New Zealand and, as we'll see, around the world. Three things I want to comment on. Firstly, what is responsible investing? Now, there should be a slide that we've had loaded, which is up now, which is good. This is the responsible investment spectrum that RIA used to describe the various forms of responsible investing. I won't dwell on every single one. In essence, responsible investing is a process that takes into account environmental, social, governance, and also ethical factors in terms of the investment process. It recognises that when you're making investments, it's not just all about the balance sheet. There are other things that need to be taken into account. And as you can see from that screen there, like a lot of things in this investment world, there's a range of ways that you can invest responsibly. And I think we've got from the right, normal investing, which doesn't take anything into account and which is just totally focused on come what may at any cost, returning a financial gain, to the far end where we've got impact investing and then philanthropy. Now, I'm not going to, as I said, step through every single one, but I think that some of the main forms of investing have been things like screening, and that's certainly very popular in New Zealand at the moment, certainly amongst KiwiSaver providers, and that's where you're obviously screening out things that seem to be particularly bad, such as cluster munitions, tobacco, gambling, that type of thing. ESG is certainly a big factor. That's probably one of the other main, I guess, approaches that responsible investors will take. That's not necessarily saying you're not going to invest in a stock, but it's incorporating or assessing businesses or assets on their environmental, social and governance standards before deciding whether an investment is going to be made or not and how much money to allocate to a particular investment. And then we move through, you've got things like sustainability investing, and an example of that will be the Global Water Fund that Pathfinder run, and John will maybe touch on that a little bit later on. And one of the more recent developments in New Zealand and around the world has been around impact investing. And that's really where you've got a dedicated social or environmental outcome which you can measure, but you're still hoping to get or you would expect to get typically a market financial return for that, in some cases a sub-market financial return. So you can see there's a whole sweep of ways that responsible investors invest. I kind of really try and simplify. I say there's two ways. One's around risk management, ESG integration, and one's where you take a values judgment on the types of investments that you're going to make, which could include exclusions. It could include a more positive approach, like investing in sustainable areas. So why is responsible investing such a big thing? Three things I'd make. I think that, and the evidence is now compelling, and that is that if you incorporate, or companies that incorporate environmental, social governance into their business practices, generally tend to have a lower cost of capital and generate better risk-adjusted returns for their investors. And there's a lot of academic evidence that's come out over the last few years that supports that, whether it be from Deutsche Bank, whether it be from Oxford University and Arabesque Partners. There's a lot of academic evidence that supports that. We can also cite RIA's own benchmark report, where they actually look at the performance of responsible funds and non-responsible funds. And by and large, not always, but by and large, the responsible fund will outperform, or universe will outperform its non-responsible counterpart. I always think that if you look at the consequences of not managing your business well in terms of the environment, in terms of your staff, in terms of governance, that's also a really good pointer around the importance of responsible investing. And you only have to look as far as BP, as Valiant Pharmaceuticals, as VW in recent history to see the impact of where you have poor governance practices, what that does to shareholder value, let alone the environment and people who are working for your business. Second point I'd make is that I think responsible investing better aligns an investor's values to their portfolios. And we're seeing that came out certainly in terms of the KiwiSaver debacle, I suppose you could describe, where it was really important to a lot of KiwiSaver holders and investors that their values were represented in their underlying portfolios. And then the final point I think is that, and this is a slightly moral view, is that responsible investing helps allocate or leads to the allocation of capital away from areas that have bad outcomes to areas that typically would have good outcomes. And so I think that is definitely a positive, and it's becoming more and more important as we look at some of the big macro themes like climate change that are playing out in the world today. So that's covered two of the points. The final point I want to make is just really give you a quick snapshot of what's happening in the responsible world in terms of New Zealand. As I mentioned right at the start, RIA run a benchmark report that surveys responsible investors in New Zealand. We've seen phenomenal growth. As I mentioned, this year we've got 183 billion of assets, or at the end of 2017, 183 billion of assets, up significantly over the last few years. That's split roughly between what we describe as broad responsible investing. They're fund managers or asset owners who will incorporate environmental, social governance factors into their investment process, and core responsible investing, which is where you're screening in either a positive or a negative sense. And this growth isn't just a New Zealand phenomenon, it is reflected around the world, and I think Katie's going to make one or two comments on that as well. There's a real broad uptake across the industry. You may have seen a few years ago that it was probably only a few institutions, maybe one or two fund managers that were really focused on responsible investing. But I'd say certainly in New Zealand and around the world, it covers a broad church of investors, from financial advisors looking at how they invest money on behalf of their clients, to the big crown enterprises, to faith-based foundations, to big fund managers, KiwiSaver providers, etc. So it covers a very broad church in terms of the investment industry in New Zealand. And the final comment I'd make is it's quite interesting when you look at some of the key drivers that came out of the survey that RIA did this year. One of the big criticisms I've always come across in terms of responsible investing is, well, this is all fine, but you're not going to give me the sort of return I would normally have gotten if I'd have taken a less responsible approach. What came out of the survey this year is that one of the key reasons that industry participants in New Zealand are placing more importance on responsible investing is because it leads to better risk-adjusted returns, and that there's this recognition that incorporating environmental social governance and more responsible approaches into how you manage money can actually lead to better returns, which I thought was very interesting and is a complete turnaround on perhaps perceptions in the past. I think certainly there's, as with any kind of movement or way of investing, there are challenges. I think we still need to raise the awareness amongst consumers around what responsible investing is and what it means. And I think also, I work quite a bit in the financial advisory industry. There are a lot of financial advisors who do incorporate it into their investment process, but I think they're a really important gatekeeper between the consumer and investment portfolios, and there's probably more work and convincing to do there in terms of the financial intermediary market. So anyway, enough of me. That's just really, hopefully by way of introduction, and just a nice scene setter in terms of what it's all about, why we're seeing growth and what's happening in the context of New Zealand. And I've got this fantastic panel next to me, and I've got a number of questions that I'm going to ask that hopefully will draw out some interesting discussion. And I think we've also got a bit of time at the end for any questions that you have. So I'm going to start off with Katie from the New Zealand Superannuation Fund. And New Zealand Super has been really one of the, I guess, pioneers and leaders in the responsible investment space in New Zealand over a number of years. And I wanted to start by asking Katie, why is responsible investing so important to the New Zealand Superannuation Fund?
Great, thanks Matt, and thank you for that wonderful introduction to what responsible investment is. I hope you're all crystal clear. But it's truly amazing to see the growth that we're seeing, and also it's really amazing to be a part of it, I have to say. And I think the industry's at a really exciting point. So we're seeing that move from niche to mainstream that Matt's been talking about, but we're also seeing some absolutely brilliant minds turn their attention to responsible investment. We're seeing managers that are adding resourcing in this area at the moment. We're seeing dedicated budgets in this area. We're seeing new hires, increased capability, increased capacity. And we're seeing the likes of very large influential investors like the BlackRocks of the world, the State Streets, the Northern Trusts, the Goldman Sachs, the Aussie super funds, large European asset owners and investment managers, are all making significant commitments in this area, and it's a really exciting time, and I think the potential is really great. And I might just also add, with regards to the spectrum, I don't know if we can get it back up on the screen, but organisations don't need to be one or the other. So for the super fund, we have ESG integration and negative screening that sits across the majority of our assets under management, but then we also have pockets of sustainability themed investing, or pockets of impact, or what we call positive investment. So it's not, you don't have to be one or the other, and actually it's about understanding your organisation, understanding your stakeholders, understanding your clients, and coming up with the right mix for you. There's no one right way. So why is RI important to New Zealand Super? Well, it's been a part of the New Zealand Super Fund pretty much since its inception. And the fund turns 15 this year. I'm sure it feels like yesterday that it was launched to many of you. It does to us. And the first real statement that we made about, public statement that we made about responsible investment was back in 2007 when the fund announced its commitment to exclude tobacco manufacturers from the investment portfolio. And actually it was a very proud moment. We were the first sovereign wealth fund in the world to make that commitment, and it's something that we're still very proud of internally. But since then, as well as announcing a number of areas that we've also we won't invest in, like cluster munitions manufacturers and nuclear explosive device manufacturers, etc. We've also done a lot of work around ESG integration, understanding what the risks and opportunities are. We've done a lot around best practice corporate governance, both in New Zealand through the New Zealand Corporate Governance Forum and also internationally, and we've really been trying to make our voice heard on best practice in that area. And we've also put a lot of resources into voting and engagement capacity, and we might get some time to talk about that a little bit later. That's two other levers under the responsible investment umbrella that we have. But why have we done this? Well, being a responsible investor is not a fluffy nice to have for us. As Matt was saying as well, ESG issues, if they're not managed appropriately, can have significant costs. They can be very value destructive, they can take up a huge amount of management time, they can cause operational risk to come to fruition, there's reputational issues, and the change just follows on from that. But on the other hand, if they're well managed, they can be revenue enhancing, they can add value to their brand, they help with retention of staff, good staff, new business revenue streams. So for us, for New Zealand Super, from an investment perspective, it's about maximising returns without taking undue risk. It's about best practice portfolio management on a global scale, and it's also about avoiding reputational damage.
Thanks very much, Katie. So, Rebekah, interesting, just going back maybe to investment philosophical brass tacks, one of the great philosophical investment debates that's going on at the moment, and seems to be going on perennially, is this active-passive debate. I just wondered how you think this applies to responsible investing.
Thanks, Matt. That's a good question. So I think, first of all, the active versus passive debate is first a philosophical debate. I thought you were going to jinx me on that one, but I managed to get it out. Discussion, really it's down to the investor as to whether you believe in passive or active management. Of course, there are ways that you can integrate ESG risks into a passive mandate. There's many organisations out there that can provide, I guess, an exclusion screen based on your beliefs that can be then applied to a passive portfolio. And that's a good cost-effective way of doing a simple sort of negative screen approach. So it's a good option. I guess one of the things to be mindful about that sort of approach is that sometimes the quantitative screens that they use are based on the information that is disclosed by the companies through, the local stock exchanges. So sometimes the information that is being disclosed may be not as detailed as what might be uncovered under proprietary, deeper ESG research. So it can be that sometimes, because of this approach, that those funds can be more susceptible to shorter-term ESG blow-ups if they were to occur. So sometimes if you're more in the active camp, the benefits of active management in this case is of course, active management can be applied in several different ways. It can be also applied by doing a simple ESG screen, or it can have a more deeper proprietary ESG approach. Now, if you look at the iceberg analogy, the tip of the iceberg is usually those types of things that are disclosed through the stock exchanges, maybe referring back to my example using the quantitative approach, and the iceberg beneath the surface, which, as you know, goes very, 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 very deep, are all of these intangible factors that relate to ESG risks and opportunities. So, back in the 70s, something like 15% of these intangible factors impacted on companies' financial return outcomes, and nowadays these are more around 86% of ESG factors that can impact on the financial outcomes of business. So a materially greater impact. So by focusing from an active management point of view on proprietary, deeper based ESG research, it means that you're looking at these longer term intangible themes that can have an impact on a business. So because it's long term, you've got to focus on more sustainable financial outcomes and more of those longer term themes, as opposed to perhaps the shorter term themes of passive management. But of course there are pros and cons to both, and it comes down to what is right for the investor and what meets their investment philosophy.
Great, thank you. And we did have a question on passive investing, which I think probably Rebekah's answer covered most of. John, we better bring you in before the session comes to an end. So again, I think one of the challenges that asset owners and fund managers have had is around their fiduciary duty and this whole idea of profit maximisation. So the question really is do asset owners and managers have a fiduciary duty to incorporate responsible investing in the way they invest or not?
Thanks, Matt. Look, the easy answer to the question is maybe. Maybe asset owners and fund managers have to incorporate responsible investment principles into their processes. Just worth taking a step back and thinking about what is a fiduciary, and because I use a lot of terms and then ultimately forget what I'm talking about. With fiduciaries are in a special relationship, and they're looking after the interests of someone else, and it may be a trustee looking after the beneficiary's interests in a trust, or a company director with a company, and fund managers are often talked about as fiduciaries, but our duty in New Zealand is actually statutory. But with a fiduciary, you have a common law or equity duty to act in the best interests of the beneficiary. And best interests historically have been thought about purely in financial terms. So just looking, if you're a trustee of a trust and you're thinking about the investment portfolio, you might look back 5 or 10 years and extrapolate what that means into the future, and act in the beneficiaries' interests based on what's happened in the past. And I'd say where we're moving now is firstly extending time horizons. So we're not just talking 5, 10 years, we're talking 20, 30 years. And we're not just looking backwards, we must look forwards, because the world is in a really interesting inflection point in terms of climate change, in terms of the use of resources, in terms of the development of technology. So we can't just look at history and expect that to give us a good guide to the future. So if we're looking forward, and we're looking forward in a 20 or 30 year horizon, it's inevitable that we want to take account of non-financial risks as well as financial risks. And, Matt mentioned Volkswagen and BP as really good examples of why you want to take account of reputational or other ESG risks when you're looking at your investments. And Facebook's another example. We don't have Facebook in our equity funds. We think the governance score is really low. And again, the issues that they've had raised recently are very much around governance. So what does all this mean? At the UNPRI, the United Nations Principles of Responsible Investment, their office went to 8 different jurisdictions and asked lawyers, do you need to take account of do fiduciaries need to take account of ESG risks or responsible investment risks when they're making their decisions? And the answer was really interesting. The answer is not a yes or no, you have to or you don't have to. The answer is fiduciaries need to consider whether responsible investment and ESG risks should be part of their process. So the ultimate decision on, yes, I'm using those principles or no, I'm not using those principles, is not what a fiduciary is all about. The acting with diligence and in good faith for their beneficiaries, they need to consider, it's a process considering ESG is what's important. And a good example is in the US, where a lot of pension fund trustees, they hold a view that responsible investment costs, it'll cost you on return. So they're saying from a fiduciary perspective that they're not going to adopt responsible investment principles because it's not in their best interests of their beneficiaries. Matt and Rebecca and I would hold a completely different view that responsible investing actually benefits you, but that's their view, and their answer is they're not going to include them, but they have taken it into account in their process. And so I suppose for New Zealand, what does it mean for New Zealand? End of last year, we had the NZX came out with their corporate governance code, which included ESG risks, environmental, social and governance risks have to be included in what companies have listed, directors of listed companies think about and communicate to their investors. And I think we're going to see more of that in New Zealand. It's not so much, yes, I'm taking account of all ESG factors, or no, I'm not, but I think for a fiduciary, it's about the process that you need to consider whether they're relevant to your beneficiaries or not.
Cool. Thanks, John. So, Rebecca, we're just going to come back to you. And, one of the transformative, I guess, issues in terms of responsible investing came a couple of years ago when, there was a lot of angst around where KiwiSaver funds were investing their money. What are the key RI issues that you're seeing are most important to consumers at the moment?
Thank you. So in terms of a lot of the research that we've done, in terms of industry research that we've observed and also research that we've done ourselves, involvement in the industry, and also feedback actually from the different generations, because the views of the different generations are actually quite different. And in fact, some people may make assumptions about certain generations, whether the older generation is less concerned. Research shows that that's not actually the case. They're very concerned about the legacy that's being left for their children and also their grandchildren and future generations. The middle-aged part of the population is also very concerned about the planet and how it's going to be left for their children. Millennials and the generation after millennials are also exceptionally concerned, and they've got a very loud voice, and they'll be very vocal on these things. So some of the larger themes that are consistently coming out, and I know, Matt, at our Responsible Investment Conference that's coming up in 2 weeks' time, some new research is going to be released, so it'll be interesting to see if this changes. But at the moment, climate change is still a very big concern at the top of the list. Human rights, so things around child labour or slavery, supply chain risk management, and also animal welfare. But some of the things that really concerned consumers is also around, they want higher levels of transparency. And as a responsible investment manager, that is something that you sign up to, particularly if you're a UNPRI signatory. That's one of the requirements. So you've got to be very clear about what you hold and why you hold it. If you have a position about a particular issue, whether it be fossil fuels or tobacco, you need to be very clear and transparent about why you have that policy, and it needs to be backed up by a very strong, robust governance framework. And in terms of when an investor is investing into responsible investment, they're also very thirsty for the stories about the active engagement that you're doing on their behalf. So Katie mentioned it before from a New Zealand Super point of view, but also from an AMP Capital perspective, that's the third and one of the most important aspects for us is around being an active owner and engaging on thematic issues that we identify. So the consumer is thirsty for these stories about the good work that you're doing on their behalf, because they want to know that the money that they've invested is doing good. And by sharing these stories around engagement, around, following the supply chain of a Kmart t-shirt from the start to the end to when it's, being presented in the Kmart store, and actually the working conditions that those workers are being surrounded by, the health and safety conditions, whether they're paid a living wage or not, they want to hear those stories. So as time goes on, the consumer is going to want more and more, so providers will have to be more and more transparent and provide this to them.
What I might do is I'll just pick up on one of the questions which is related to what Rebekah was talking about. The question is, should a provider that only applies exclusions be able to represent themselves as a responsible investor? And certainly I think that when the issues around KiwiSaver came out, there was a rush to exclude tobacco and cluster munitions, etc. But certainly what I'm seeing is more and more of the big institutions and KiwiSaver providers develop more holistic and well thought through responsible investment policies. One of the things that RIA does, and it's not a plug for RIA, but just as an aside, is that they certify product, and that provides quite a robust framework by which they'll assess whether a responsible investor or a fund manager is actually meeting the minimum standards. And I'd say, just by excluding tobacco and cluster munitions, it's at the very, very low end of what could be described as a responsible investor. But I'll be interested to hear the panel's thoughts on that question.
I'll take that first. Thanks, Matt. Look, I think it's a great question. I think the interesting thing with responsible investing is that it's changing, and I think we're going to see the pace of change increase in the next 1 to 5 years. If we go back to 2016, you were a responsible investment manager if you just took tobacco and landmines out of your portfolios. I think the world's moved on from that now, and I think it's a bit rich to call yourself responsible if a handful of exclusions is what is as far as you're going. And I think that reflects social values. So in New Zealand, that was really important for KiwiSaver investors in 2016, but with more awareness and education, I think we've moved a long way on from that now. And to answer the question directly, no, I don't think just taking tobacco and controversial munitions out of a portfolio gives a fund manager the right to actually label themselves as responsible. I think it's conventional.
I would also have to agree with that. The faith-based organisations over 100 years ago began excluding sectors that brought harm to communities. So negative screening has been around for a very long time. So a negative screen is really just defining your investable universe. So I personally also would not describe that as responsible investing. A responsible investing policy needs to have very clearly articulated items that it's going to achieve. So maybe the first step might be defining what it's not going to invest in, but it has to focus on the positive aspects of what they're going to achieve and what themes they may be focusing on, and also what they're doing from an active ownership point of view. But I think the important thing to note, and John, you picked up on this, is that it's also a journey. So everybody starts their journey at a different place, and it's great to see that so many of the organisations in New Zealand have started that journey. And I would really love to fast forward into 5 years' time to actually see where the industry ends up. I'd like to see that it's just mainstream and that actually we're doing more and more and actually talking about impact investing and looking at social and financial outcomes for our investors, and not just ESG integration.
I'll just add, I mean, we're looking long-term here as well, particularly from NZ Super Fund's perspective. The fund's not meant to peak in size until the 2080s. It's truly intergenerational. We have to look to the future. We have a belief, one of our investment beliefs, that we have to look at and analyse ENS and G issues because it will impact investment performance over the long term. So it's not only about excluding those areas which may not fit with your moral, ethical judgments. It's about understanding how the world is changing, about understanding how the environment and society are affecting things. We have to act in a way that's going to create capital to keep to keep on a sustainable path. And so we've got to look out to the future and understand how those trends are affecting the companies that we're invested in and account for them.
Thanks, Katie. Just coming back on, one of the things I always think about that's really interesting around responsible investing is it captures a lot of the big macro themes that are going on in the world. One of those, obviously, is climate change. And I just thought it'd be quite interesting just to get a quick take on or an overview of how, talking about responsible investment policies, how NZ Super has approached climate change.
Yeah, sure. Actually, there was just one thing before I go there about the passive-active debate that I wanted to add, Matt, if you don't mind. But just to say that I think if you are invested passively, the responsible investment side, particularly from an engagement and voting perspective, is particularly important, because if you are invested with these companies for the long term and you're not going to sell out no matter what, then you've got a voice that you can use to ensure those companies are adapting, preventing risks over the long term, having best practice corporate governance elements, those sorts of things. So it's not a matter of if you're passive then you don't need to worry about it. It's actually even more important from an active ownership perspective. So climate change. So the Super Fund launched its climate change strategy in 2016. And this was on the back of quite a number of years of work and research. And basically it was the start of the beginning of the journey for us, when we'd finally got to the stage where we were comfortable that we knew that the transition to the low-carbon economy is happening. We were seeing changes in technology. We are seeing policy, global agreements, that sort of risk, if you're on the wrong side of it, happening. We're seeing physical risks come into play from climate change. And it was, finally at that point in 2016 where we had our board and our CEO and our CIO and our investment committee lined up and ready to act. And that's when we launched our climate change investment strategy. I'll add, it's an investment strategy. We separate it, we look at it differently to our ethical exclusions, because we see it as a long-term investment risk, and our goal is to make the fund more resilient to climate change risk over the long term. We've got a couple of pillars where we're to the strategy. The first is where we're reducing carbon intensity. We're reducing the whole of funds carbon intensity over time. We've built in an analytical framework to look at the long-term risks and opportunities for investments, for both existing and potential investments. And we've got an engage part where we're using our influence to see how companies that we're invested in are managing these risks. Have they got board support for it? Is there a strategy in place? Are they looking at the implications? And then we've got a search element where we're actively looking for investments that can help with mitigating or adapting to climate change issues. I'll just quickly say, I guess the most exciting work that we've done was in 2017 we transitioned our passive global equities portfolio to be lower carbon. So that resulted in 950 million New Zealand, selling out of 950 million New Zealand, about 300 stocks, and redistributing it via market cap back into the passive. But what we've done is we've got a goal to try and reduce the carbon intensity of the fund by 2020 by 20% and reduce exposure to fossil fuel reserves by 40%. And that was our first step to transition the passive global equity portfolio. And we're slowly working through the portfolio since then. So we've also implemented a low carbon approach in our emerging markets opportunities, and we're looking at the more active ones now.
Great. Okay. I think there's quite a few questions that have come up. What I'll do is I just wanted to ask John a question on regulation because it's quite topical at the moment. There's a lot of change coming through in terms of Financial Markets Conduct Act, the Financial Advisors Amendment Act, and also the Code Working Group, and there's other bits of legislation as well. John, could you just make a few comments on how responsible investing can work with regulation?
Okay, thanks, Matt. First thing I'd say is it is actually a really exciting time around regulation and financial services in New Zealand, and it's not often you get to use the words exciting and regulation in the same sentence. But essentially what we're doing, particularly around financial advisors, is moving to a more principles-based approach. If you think of regulation in New Zealand at the moment in terms of responsible investment, we're as an example of a rules-based approach. It's for default KiwiSavers have to say whether they have a responsible investment policy or not. So it's a yes, no, easy to comply with for providers, but actually doesn't give much information to the consumer, particularly if someone says yes, you actually don't know what level of responsible investment they're screening to. So what we're moving is to a more principles-based approach in New Zealand, and it's sort of coming from three angles. Firstly, on the disclosure front, MB are drafting new rules for disclosure by financial advisors. So rather than just handing over a pile of paper to a client, you're actually going to have to think now about what you disclose, when you disclose it, and how you disclose it. So those rules are being drafted at the moment. Alongside that, with the Code Working Group, we're working on a new Code of Conduct for financial advisors in New Zealand. The current Code of Conduct covers just AFAs, which is a universe of about 1,800, and that will be extended to cover RFAs and also QFE employees as well, so it will be a universe of about 25,000. And a lot of people say to us, can't you just make a rule book and we can tick the rules off? But actually, when you've got a universe that size, it would be a telephone book of rules. It really has to be principles based, which is really cool because from a client perspective, it is customer centric. It's all about looking at things from the understanding and perspective of the client, so it's better outcomes for the client. And the third area where regulation is changing is with the FMA and licensing. So financial advisors and financial advice providers are going to have to be licensed, and that will be both rules based and also with the FMA's focus on conduct, there will be a lot around a lot of principles-based stuff there. And just very quickly, what does it mean to move to a principles-based regime? In my mind, what it means is you're shifting responsibility from the consumer to the provider. So at the moment, we hand information to consumers and say, here's all the information you need, go and figure it out. It's actually going to be turned around. It'll be the provider's responsibility to provide information in a way and that the consumer understands and help them understand with that. And I think further thing is really for financial advisors in the responsible investment world is for your client to understand the product they're investing in, and for you to understand what your client needs or what their goals are, you must ask what their values are and do they want their values included in their investing. And I know a number of advisors do that at the moment, but a number of advisors don't as well. But I think to comply with the new regulatory world and also the FSC code, which is I think code standard 3 there is making sure your client is given information to understand the product. To me, that also means you need to understand what their thoughts are on responsible investment and need to help them understand how the product meets those.
Okay, so we're probably getting close to the end of the session. Maybe just a couple of quick snapshot answers to some questions from the floor. Should RI be compulsory for KiwiSaver providers? Should there be a compulsory requirement?
I'll have a stab at it. For me, because you read a lot of comments from people and they'll say, this is all rubbish and we don't need to invest responsibly and business is all about maximising profit. And I think it's a choice thing. I think what's important is that providers are clear and communicate what their policy is on responsible investment. Investors have to have the choice, the full suite of choice, whether it's incorporated or not, but it's a matter of they need to understand what's on the label and what they're investing in.
Okay, so we've got the countdown here, so I'm just going to ask, just to finish off, each of our panellists to just say a few words on where they see responsible investing going over, the next 5 years.
I'll start, yeah, sure. I think that broad and general acceptance of what responsible investment is, that you don't necessarily need to sacrifice returns, that sort of general understanding by the general public, I think we'll see. And then the other side, we've sort of briefly touched on it in a number of conversations, but that growth of impact investing, and I think we're seeing a lot of it happen internationally at the moment, where investors are sort of mapping their current portfolios and then looking to allocate capital in the future to help the UN Sustainable Development Goals. That's a very interesting piece of work that's getting a lot of focus internationally, and I think we'll see more and more of that in the future.
Okay, some similar themes here. So I'd like to see more broadly integrated responsible investment approaches by New Zealand. I'd like to see the green bond market growing in New Zealand and more options available for investors. We're beginning to see this now, and we've started doing it. I'd like to see the SDGs, so the Sustainable Development Goals, more broadly integrated and adopted by people. I think it's a great framework that allows everybody to talk the same language, so it's very easy to compare and to analyse. I think there's going to be more and more tools. In fact, I went to a PRI working group in Sydney last month, and there is a tool that's being developed that will essentially upload all the holdings of portfolios by ISN codes and give you an average score on and against SDG goals, and then you'll be then compared to your peers in the market, and this will be available for consumers to see. So the transparency is only going to become, and visibility, more and more prominent. So I think those tools are pretty exciting, and I think a great movement. Also, I know Conscious Consumers have released their new framework, and that's going to be rolled out in New Zealand, and I'm sure that there'll be many others to follow. And I think from an investor point of view, success for investors maybe need to be redefined. So rather than the old traditional approach of a benchmark relative return objective, maybe focusing more on outcome-based investing, so objective-based with both financial and social outcomes, and more development in the impact investing space as well.
John, you have no time, but give it a go.
We've got a sign flashing to say time's up, so I'll be very quick. One of the key themes, I think, in the next 5 years will be a change around consumers. Values will change, and also awareness will change for responsible investing. And I think what that means for providers is there'll be a lot more pressure to be authentic, and in our communication, both direct communication that marketing departments produce, but also just in the way we're branding and presenting ourselves to customers. I think there needs to be really clear on what the responsible investment approach is, and also not just talking the talk, but also acting it out in the way we invest.
Thank you very much. And listen, thanks very much for your interest in coming along to the session today. Hopefully it's been interesting from your perspective, and you've learned a little bit more around responsible investing and the benefits, etc. So thank you very much, and back to you, Yvonne. Thank you to the panel.